So let's set the stage for one buyer's path to closing. This is the same acquisition you'll see verified with real numbers later in this section. So the picture this, one buyer's path. They started with an independent sponsor signed a LOI for a $12.4 million cosmetics distributor backed by conventional debt, a seller note, and some equity. Um, During the due diligence, the uh, buyer commissioned a proof of cash, and during the analysis, the January bank statements were showing 2.3 million in credits, uh, credits representing some cash receipts, well above the reported revenue. The lender as well as the buyer wanted clarity of the discrepancy between what's showing on the bank compared to what's showing on the reported financial statements. The first thing that comes top of mind is this could be a difference between accrual basis financial statements and the cash basis bank statements. If you think about your own bank account, as cash comes in, it's very likely those are showing up as credits. If it's as you're paying off credit cards and expenses, those are being, debits. Um, so when you're thinking about an accrual basis financial statement compared to a cash basis, you would expect some differences. But when there's large discrepancies, you want to get clarity around this, especially when lenders bring it to their credit committees, etc. Um, so when we came across this, it was very likely it was a few accrual items, etc. But before it could go to closing, you needed clarity on this. So we were looped in to commission this proof of revenue or proof of cash, um, and in closing, the proof of cash reviewed and it cleared 350K in transfers, and the remaining 1.9 million was reconciled from accrual basis to cash basis items, and ultimately this deal did close. So this is an example. I bring this up because if you are under LOI, um, whether or not you engage a CPA firm like OAG to conduct a proof of cash, it's important you understand the implications and what the scenarios look like and why you should conduct this sort of analysis. Um, if there's material discrepancies from bank to book, bank being the bank statements, book being the financial statements, you want to understand why. Is it simply because of accounting, cash basis versus accrual basis? Are there items on the bank statements that might not be getting recorded? Um, Before you close, those are the questions you want answered. So, what are some of the key steps in the proof of cash in the financial due diligence? So we're going to start with comparing the reports and the statements. You're going to verify a company's revenue by comparing it to detailed financial reports and then looking at the bank statements. What this looks like in practice is you should be requesting about 3 years of monthly bank statements and comparing that to 3 years of monthly financial statements. So, if we're doing one today, at a minimum, we would be doing a proof of cash over January 2025 through today. So it's about an 18-month window if we talk about closed bank statements. And you're going to line those up in a single Excel document. A little bit later, we can flip through what a typical one of these looks like on a completed basis. Once we go through some of the examples, it should be kind of clear at least what the end product should look like. And really the purpose of it is if there are differences on a monthly basis, it helps you get an understanding of how cash moves through the business. Um, if you are buying a small business, how cash moves through the business is absolutely mission critical. It has implications around valuation, your ability for working capital. Working capital, I've had conversations around on my YouTube channel. I'd encourage you to check out those. We have deep dives on how to calculate working capital, why it's important, and how a lot of buyers get hurt if they don't consider working capital before closing. So how the cash moves through the business is what you're going to gain from commissioning something like this conducted. So once you have the monthly financial statements lined up and you layer in the monthly bank statements, you're comparing those line by line, so month by month. And you're looking for, items that appear to be non-revenue or non-expense related. So what does that look like? If you open up a bank statement, if there are items that are deemed non-operating, like transfers in, transfers out, those are bank activity, which is increasing or decreasing your bank balance. Those should be pulled out of this analysis. And the reason why is because that's non-operating activity. If cash moves through a bank statement, if you think about your own bank statement, if you were to transfer funds from bank A to bank B, your bank B balance would increase. Let's say you transferred 100 grand. If you transferred $100,000, those items are simply just cash moving in and out. You wouldn't expect that activity to be recorded in the financial statements as revenue. That's the key test here. It's the same practice for expenses. Occasionally in small businesses, what we see is some of the bookkeepers involved may accidentally record some of that bank to bank activity as operating activity in the form of revenue and expenses. Whether it's done intentionally or not, the point of this exercise is to make sure if those things are occurring, you need to pull those out. And you need to make sure the book statement you're looking at, whether it's in QuickBooks or the other accounting system, is excluding some of those non-revenue and non-operating items from the P&L, because that impacts valuation. I'll give you a real life example we've seen in practice. So let's say hypothetically you're paying 5 times earnings for a small business. So if the business is generating $1 million of EBITDA, you're paying $5 million for the business, out of 5 times earnings. A few months ago, we came across a $100,000 line item, which was transferred from one bank account to another. During the monthly closing or the monthly bookkeeping, which is done by the fractional CFO, this amount was incorrectly recorded as revenue, as a customer revenue. When we were doing our financial diligence, this came up because we couldn't link this cash amount to a customer. It didn't have a customer name because it wasn't customer revenue. But the bookkeeper accidentally or incorrectly or in error recorded this as revenue. That has real implications to you from a valuation perspective. Assuming it's a 5 times multiple, you effectively were paying and were going to pay $500,000 for that clerical error of the business. So I set the stage and I put a dollar amount behind some of the implications around why this analysis is mission critical, in my opinion. If some of these items are overlooked, you can risk overpaying by several $100,000 very quickly if you think about the multiplication for a market multiple. So the result is, if you conduct this test thoroughly on a revenue and expense basis, you should get clarity around the cash needs of the business. You should ensure that there is a low risk of a material misstatement from bank to book. It's always best practice. I think this is one of the analysis that's most important, in my opinion, during financial due diligence. So if you are just starting out with your business search, when you do engage, and get a contract under LOI, I would absolutely require your CPA firm to conduct this analysis on your behalf. So hopefully this gives you a little bit of a picture of what this looks like at a high level. So what are some of the critical considerations? Some of the best practices we talk about are, you want to work month by month for accuracy. You want to make sure wire transfers from customers, those things are being watched very carefully. And you want to make sure there's, you're looking out for things that are falling in the common pitfalls. Some of the ways this analysis gets screwed up is you don't consider the cash to accrual differences. If you don't have an accounting degree or you don't come from finance, this may be very challenging for you to understand how some of the accrual basis items needs to be adjusted to compare this analysis so it's apples to apples. Um, Also, incorrectly setting up the grid is something that can cause people some problems if they're trying to do this analysis independently, on your own. Um, the best practice is to always work with a transaction firm like OAG or another transaction firm who is used to preparing this analysis because it's very challenging. And if there is a complication, an item such as a transfer, uh, you may have a biases to overlook this or push this aside. And that's really where the value of hiring someone is conducting a third party analysis. You know, we are not incentivized for this deal to close. We are incentivized to give you clarity around your deal. So when we see things like the transfer, for example, we bring it to your attention. And I've spoken with a few business buyers who always say they should have gotten at least a proof of cash done at a minimum, because it really is the fraud test. This tests the accuracy of the financial statements as well as the risk of fraudulent manipulation for these small businesses. If you're still with me, now's a good chance to scan this QR code for our Business Buyers Toolkit. So if you've joined me on previous webinars, this toolkit has been updated for the 2026 version. It's at 92 pages. This contains all of our, some of our best templates free for you, like the Business Buyers Toolkit, the Financial Due Diligence Checklist. So like what sort of data do you need for these sellers? What does the due diligence process look like? What are some questions you should be asking sellers? If you're actively searching for businesses and you speak with a seller, what kind of questions should you ask them? This is chock full. I use this on all of our deals. I think it's a great toolkit and a single file you can reference during your deal, free to use. So hopefully it's a benefit. If you have folks in your network who may benefit from something like this, feel free to point them in the direction of this webinar. If you scan this QR code on our YouTube channel, you'll be able to get this to your inbox right away. If you are still with us, feel free to scan it on the screen now, and you should get a copy pretty shortly. So while we're giving people a couple extra seconds to scan that, if you have any questions about something you're working on or things we just covered, feel free to raise your hand. Again, this typically folks who join this who are new to the space, they get as much as they put into it. So if you have questions around anything we're talking about, feel free to raise your hand or deal making in general. This is a very open forum. So happy to chat one-on-one with you now here. Alrighty. If you need to flip back to this, let us know. But for everyone's time, we'll keep things kind of moving. Alrighty. So we're gonna get into a case study. If you go one more over, I would like to start with that visual because I think it's a good job of seeing a snapshot of the proof of cash. So we kind of talked about it. Independent sponsor, 12.4 million of revenue, etc. But let's take a look and dig into like what this grid actually looks like, at a high level. So I'm going to share my screen and pull up one of our decks. Now this is an example of a proof of cash we've recently done. Give me 1 second as I pull that up. This is going to be in an Excel copy. So we kind of talked about the components of it. So what are the components of this cash proof? The first step is really lining this up. So you'll see, without to be as valuable as possible, this is what a proof of cash looks like. So you're going to see there's a couple things here. So it's going to have things like deposits. So these represent your bank deposits as they come in to your bank statements. Really, the point of this exercise is to make sure you have a variance no more than 1%. You'll see here it's lined up on a month by month basis. So for this proof of cash, the last period available was May of 2026. So it's going to have the bank deposits for the bank statements. Then it's going to have reported revenues. So reported revenues, think about gross revenues per the accounting system. In this case, it was QuickBooks, etc. Once you schedule out each of these items, so you're going to line up and grab the bank statements for January, February, March, April. You're going to schedule them out, and then you're going to compare that to what is in reported revenue per QuickBooks file. So if we think about this at a high level, I'm going to highlight these two items. Total income is effectively total income per accounting system, or we'll say per QuickBooks. UBO. And we'll say total deposits per bank statements. Think Bank of America, BOA, or Chase, or, you name it. When we start to schedule these items out, ultimately, we want to compare this to the variance. So the variance is going to be the difference between the anticipated cash flow, which is going to be anticipated cash flow per the books or per QuickBooks, compared to the total deposits per the bank statements on a month-by-month basis. So this is the end result. So if we take, for example, let's do August 2025 as a good example. So in August 25, we had $537,000 of bank activity inflows. We talked about transfers. So within the bank statements, on your Bank of America statements in August, it appeared that there were a few items, about $30,000 of transfer activity between banks. In this case, there was another bank account outside of the business, and they transferred money into this operating account for $30,000. That $30,000 should not be recorded as revenue. Why is that? Because it's not operating revenue of the business. It's simply cash coming in from another bank account. So when you are a business buyer, put yourself in the buyer's shoes, you should not be paying a multiple for someone moving cash between bank accounts. So that needs to be removed. Removed from your total deposits per bank statements on an adjusted basis. So this $507,000 is what we think the true revenue on a cash basis should be for the business in August. That is what this means. So in our opinion, after reviewing the bank statements, the company generated true operating income of $507,000 based on the review of the actual bank statements. That's step one. Step two, you are going to open up your QuickBooks financial statements on a monthly basis, and you are going to populate this grid with the reported revenue. So on a reported basis, it's $579,000. This should include all of the things in gross revenue per the QuickBooks statements. I encourage you not to exclude items as presented because that can manipulate this. So in our opinion, the total income should be $580,000 of adjusted revenue on the books in QuickBooks. We consider other income for only $1,000. It's immaterial, so I wouldn't pay much attention to it. Here is where you have to put your accounting hat on. So if you recall in the beginning, The bank statements are operating on a cash basis. As when cash comes in, the bank account goes up. When cash leaves to pay for things, bank account goes down. Think about your own bank account and how that operates. A company's QuickBooks is very likely reported on an accrual basis. If you don't know what an accrual basis means, that is an accounting term I'd encourage you to look up. It's a very different way to account for things than when cash comes in and cash leaves. In this case, the business was operating on an accrual basis, so we need to adjust the accrual basis QuickBooks to cash basis in order to show apples to apples. So how do we do that? In most small businesses, this is going to be done by taking the change in accounts receivable. If you are not an accountant and this is way above your head, when you do go under LOI, you're going to need to engage a CPA firm to conduct this analysis for you. And the reason why is because of the generally accepted accounting principles. If you're not able to do this accurately, this needs to be done by a professional, OAG. This is what we do for a living, so we'd be happy to do this for you. Continuing on in August, the change in accounts receivable went from $73,000 to $160,000. So it increased. You'll see here the change increased by $88,000. How does that impact our grid? Again, you're putting your accounting hat on. If accounts receivable increases, what does that look like? Going to journal entries, accounts receivable has a debit balance on the left side if you do the T account. When you debit accounts receivable, you credit sales revenue or reported revenue. So AR has gone up, revenue has gone up, but there is no cash activity. There's no cash activity that occurred when AR is increasing. In this case, if AR is increasing, your revenue is increasing on an accrual basis. To show apples to apples, when AR increases month to month, that change needs to be decreased from your reported revenue in order to go from accrual to cash basis. If you're still not following me, I would encourage you to look up the differences between cash and accrual basis. The point is, given this AR balance increased from month beginning to month end, you need to subtract your total reported income by this change for $491,000. So what this means is our anticipated cash or income per QuickBooks on an adjusted basis for the month of August should be $491,000. And we compare that to our total deposits per the bank statement on an adjusted basis. So our unreconciled difference is $491,000 compared to $507,000. So that's a $16,000 variance, about 3%. Month to month, if it's within 5%, I think you're okay. On an annual basis, each year, if it's greater than 1%, you need to look in and make sure you're capturing all activity on the banks and book statements. If there are still discrepancies after you've done this, you need to speak with management because there may be A, something you're missing on the bank statements or the books, or B, something is incorrectly recorded in QuickBooks on the accrual basis statements. So hopefully walking through this August example, start to finish, gives you an idea of why you do things and how you should be doing them. This single month is then repeated in a similar manner over as long of a period as you'd like. In this case, it's typically done over 2 to 3 years. And then the total amount is adjusted and annualized over the period. If you have any questions on that, I'm happy to answer them. I know that was a lot to unpack, but that's how you do a proof of revenue. A similar exercise is done for the proof of expense. This is one of my favorite analysis because you understand how the company is recording transactions on a month-to-month basis. You can get a lot of clarity around this, and it's one of my favorite analysis to do. So what are some of the red flags that hurt valuation or screw up this analysis? Unexplained deposits, inflows and outflows, related party payments can also blur the lines here. There might be some issues around how they're recording some transactions, etc. If you want to scan this QR code, this should link back to the YouTube channel or the toolkit. This is another snapshot of a different proof of cash or revenue example. You'll see here that we're comparing the cash receipts less some non-revenue items like transfers to show the total adjusted receipts. And then we're comparing them to the expected cash receipts per bank. You'll see that it's B minus A. The variance should be about 1%. If you want to do some more digging and get that under 1, that gives you comfort that the risk of a material misstatement from bank to book is very low.